Hey, it's Stuart. Today's question of the week is from Leo, and Leo writes about rental yields and how they increase over time. What Leo can't understand is why we don't increase rental yields in projections for investment properties by the same rate as the capital growth. Because if the property is growing at, say, 8% per annum, but the rental yield, the actual income from the property, is only growing at 4% per annum, then over time, the rental income from that property will be a smaller proportion relative to its overall market value. So that means that if we assume that a property yields 4%, so $1 million property produces an income of $40,000, if that income doesn't grow in line with the value of that asset, then over time that yield will reduce. In 10 years' time, it could be 3.5% or 3%, and so on and so forth. What Leo can't understand is why do we make that assumption when we produce property investment projections? And it's a great question, one that I've really thought about. I mean, if you chart rental yields since 1980, what you will see is that yields were 6, 7, 8% in the 80s, and then they compressed and they fell to around about 3% by around about mid 2010s. And since then, they've been relatively stable. If you have a look at historic growth in rental incomes, the growth has been about 4.3%. So if we have a look back over the last few decades, on average, over long periods of time, rentals have increased by 4.3%. But as we know, property values have increased a lot more than that. I think it's really important to understand the cohorts that are driving these increases. So it's a different cohort that's driving property increases than is driving rental income increases. Blue chip property, particularly in great suburbs and so forth, is driven by the wealthiest 20% of Australians, essentially. And the wealthiest 20% of Australians have other sources of wealth other than their income. So their ability to pay more for a particular asset isn't as closely tied to income as it is for other cohorts, other socioeconomic people, like your average Australian, if you like. Their ability to pay more for their home is very closely tied to how much income they're earning and how much they can borrow. And we know borrowing capacities have been stagnant for many years. So, of course, that's the reason why property prices increase so substantially over long periods of time in Australia, particularly in blue chip locations. But the cohort that's driving rental incomes is in a completely different position. And typically that's much closer tied to income. And that's why I think rental incomes have only increased by 4.3% over the long run. A renter, not all of them, but most of them can't afford to buy the asset that they're living in. And so renting is an option. About a third of Australians rent property. So there's certainly a large cohort that need to or choose to rent rather than own. But their capacity to be able to pay more is typically closely linked to their household income. And that's why I think it's really important when we're doing property projections. In our business, we use 4% typically as an assumption in terms of rental increases over a long period of time. But we might assume 6.5%, 7%, 7.5% in terms of property capital growth rate, so the change in value of that asset over time. And we acknowledge that mathematically that means that yield will compress over time, that if our starting yield is 3%, in 30 years our yields might be as low as 2%. We get that, but we're quite happy or comfortable with that assumption and that outcome on the basis that we feel like that's probably most likely. And if anything, it's conservative. And if that doesn't happen and yields actually remain steady over the next period of time, well, that's all upside. Great question, Leo. It's one that I've thought quite deeply about for a long period of time. So it was. I appreciate being able to share my insights. Hope that makes sense. Cheers.